Hello and welcome to another video on my YouTube channel. So today I'm going to talk about saving and my rule of 300. So saving is really important, but it is hard. In contrary to what you always hear on YouTube, like they seem like that saving is really easy, but in fact it's really hard, and especially here in Switzerland. So what you need to do in order to be able to save is, of course, make a budget. So you have to look at your income, and that's the positive side. And you have either an active income, and that you get from working for an employee or yeah, I'm talking in German now, but working for yourself can also be the case. And then of course you also have passive income, and that comes from investing, or when you wrote a book and you receive royalties on the the selling of that book, you can have income like that as well. And then of course you have your expenses, and those are what is going away from what you have as an income. So that can be the rent or the payment of your loan, and of course the insurance on your house or your furniture. The health insurance is a big deal here in Switzerland, especially. Then the food and the clothes and the shoes you have to buy. Then you have all different kinds of bills for the electricity, the water, the heating, the internet, and your mobile phone. Then of course you need to be able to move as well, so you have your car, the insurance for your car, other transportation. Here in Switzerland the öffentliche Verkehr, so the public transport is really good. So yeah, we take the train as well, so we pay money for that as well. Then hobbies are important as well, and then when you subtract your expenses from your income, that determines what you can save. So if you look for at a family of two parents with two kids, they on average in Switzerland they will have an income of more or less 2 times 4,600 Swiss francs. That doesn't come from me. That's something I read, I think 2 or 3 weeks ago in the 20 minutes when I was riding to my work with the train. And so on average, people are earning 4,600 Swiss francs per month in Switzerland. So that amounts to 9,200 in a month. And let's say that they haven't invested yet, so and they didn't wrote a book or made music in any kind of way, so their passive income is zero. Then they have expenses as well, so the rent, because they need a rather big house with the two kids, it will be 2,150 more or less. The health insurance, it's 700. The food in a month is plus minus 1,500, and then clothes, shoes. So if you think about it, 300 francs for 4 people in a month. That means that yeah, it's 3,600 francs in a year. That's actually not much. So especially when your kids are growing fast and you need to buy shoes every 6 months or every 4 months, and then a new coat and stuff, that takes a big chunk of your pay bill, and of your income of your work. The car insurance and other transportation, I put it at 550. That's more or less what we pay per month here now as well. And then for the hobbies, 600 francs. That's actually also not that high. So with four people, that's only 150 francs in a month for every kid and every parent. So yeah, you don't get far with that amount of money. And then other stuff, I've put 450 on that, but don't remind I want to remind you that we also have to pay income tax on what we earn here, so that's more or less 10%. So it's a little bit less here in Canton Bern, so it's I put it at 900 francs, and all the rest adds up to 6,850. So when you calculate it, it means that the family can save plus minus 1,450 Swiss francs, and it's a family of 2 kids. I must say I have 3 kids. I have 3 daughters, so clothes wise that's pretty awesome because we can just pass the clothes from one daughter onto the other, but that's beside the point. So this family in our example here can save 1,450 francs. And what to do if you can save here in Switzerland, and actually everywhere in the world, this is the case. First, you have to save in a bank account for your safety net, and this amounts from 3 up to 6 times your monthly income. So this means that the family that we have as an example needs to save up to 27,600 francs or 55,200 Swiss francs. So this will take them with their 1,450 francs that they can save per month. It will take them 19 up to 38 months to save that amount. So that's already a big time. And when you look at other videos on YouTube, they just say start saving, start investing, and it's as simple as that. But if you look at that, 38 months, that's already more than 3 years. So it doesn't come easy like that. And then you can say, okay, I will start investing right away. But a safety net is pretty awesome when you have it. And when you need it and you have it, then you're really happy. So I would always advise to first take care of the first point. Then, if the family rents a house and they want to buy a house, then of course they will need to save until they have 20% of the price of the house they want to buy. That's an obligation here in Switzerland. So when they want to buy a house of 500 francs, 500,000 francs, then they need to pay to the through the bank to the owners immediately 100,000 francs. And then you have the costs as well, so that amounts up to 5% as well. So I have 5,000, 6,000 francs. So it's 1%, 2%. It's not 10%, of course. But saving money is key when you want to buy a house. Luckily, the third point, so the third pillar savings account that you can have here in Switzerland to save towards your pension, can also count towards saving for buying a house. And currently it's 6,883 Swiss francs per person per year. So per person per year, that's per month, that's 573 Swiss francs. Later on in one of the later times in the presentation, in this video, I will round it up to 575 Swiss francs for the ease of calculation. But as I said earlier, this money can also count towards your payment of the 20% for the house. So your bank is then going to talk to the institution that holds your third pillar account. Sometimes that's the bank where you're going to take your loan, sometimes it's not. But you can always buy back the money you put in the third pillar saving account for a certain amount, and the bank will take then that as fund and give you the money towards your loan So add it towards your loan so that you don't have to really sell your third pillar saving account, and that you can keep that money towards your pension later on. Of course, when you lose your job and you can't pay your mortgage anymore, then of course they are going to take the funds and you will need to sell off your third pillar savings account. So that's a minor point, but normally that shouldn't happen. And then the most important point on this slide is actually only invest money you don't need for the first 3 points. So first take care of the 3 points and then look into investing, because buying a house is really important, saving for your pension is really important. So I would advise always to take care of the 3 points first. What to do if you can't save? Well, you need to cut your costs. So look at other internet subscriptions that maybe cost less than what you are paying right now, and still has sufficient data or speed that you can still do what you are doing now. Use a shopping list when you go to the shop to buy your food, and stick to it. So don't buy things that you don't really need. Turn down the heating, that's a really important one. So some people have their heating on 24 degrees. Put it down to 20 degrees. That's what we have it here, or 21 degrees. When you think 4 degrees less is immediately a big jump, just do it 3 degrees down. It will save you a lot of heating costs. And go over and negotiate your insurances with your insurance companies. So pay attention to the deadlines then as well. So when you want to switch, because when you are too late you have to wait another year, and I think it's mostly November that you have to negotiate your insurance deals. So keep that in the back of your mind. Try to earn more. That's of course easier said than done. So what you can do is when you are on the active side, you can go and find another job that pays you more. But yeah, that's not always that easy. And for your passive income, try to earn money with your hobby. So that's an easy one. Some people are really lucky and do that. I don't do that. I just do things for my hobby, and I don't earn any money with it. And then try starting to invest. That's that's actually what my YouTube channel is about. So investing, and this means that there is actually a contradiction between the advice when you can save versus when you can't save, because when you can save, it states that you can only invest after the other 3 points are fulfilled, and when you can't save, it says that you need to try to invest to increase passive income. So in order to achieve this and don't get frustrated, you have the rule of 300. So that's what I agreed upon with my wife. So that for the rule of 300, we agreed upon that we will put aside every month 300 Swiss franc and put it into something that gives us a passive income of 4% in a year. Why is that really important? So yeah, when I was young, we had obligations that gave 13%, 14% even. So when I was 10, 13 years, that was the last moment that you could buy such great obligations with 10% or higher uh, dividends on coupons on it actually. but yeah, then it started to decline, and now when you have an obligation that gives you 4%, then you're really happy. And we chose to invest it in ETFs. And so when the ETF gives you 4% on the 300 francs that you invested in it, then you will receive 12 Swiss franc every year, and this is equal to 1 Swiss franc every month. So we look at it in the following way: every time when we can put 300 francs aside, we increase our income with 1 Swiss franc in the month. So passive income, it increases every month with 1 Swiss franc. It doesn't seem much, but it keeps adding up. And in this regard, you can't underestimate the power of compound interest. So when I was 9 years old, I read the book of Roland van der Elst. Roland van der Elst is not known here in Switzerland, of course, because it's a Flemish investor that wrote a lot of investment books back in the days. And I I rented out this book from the library and read it when I was 9 years old, and there were tables in it where you put aside one Belgian franc back in the days, and you received 7% interest rate, and the table was, yeah, for 30-40 years long. And the way it increased, it just blew my mind when I saw those tables, and I said, okay, I need to start to invest. So from the moment I was 9, I was reading more and more books about investing, and when I was 14 years old, I bought my first stock together with my mother, of course, because you need to have a guardian that comes with you to the bank to open an account then. But that's a story for later. And then, of course, yeah, compound interest gives a huge snowball effect. So it starts small, but every year it gets bigger and bigger and bigger and bigger and bigger. And in the end, yeah, the amount of money that you have in the stock market is actually more money from your dividends that you received than from the money you put in initially. So then you are really making money on the stock market. And it keeps you motivated to keep saving, because 300 francs gives me 1 Swiss franc extra every month, and you are you are seeing it grow every time when you receive a dividend as well. So that's really nice. So in the example of our family of 4 that saves 1450 Swiss francs, 300 francs goes towards ETFs, and 1150 goes towards the third pillar funds. So that's the 575 francs times 2, because you have 2 parents, of course, that go working, so you can have 2 third pillar accounts. And that covers actually the first point and the second point and the third point. And you can only start to invest after you have your safety net. So those 19 or 38 months are already passed when you start investing in stocks or ETFs. So we chose ETFs. And why? Because most of the time they have a small price, and it comes with built-in diversification, and that's really great. So when you invest 300 francs, it's not that easy to buy a stock at that price, and yeah, have great diversification with only one stock. So but when you buy into an ETF that follows an index, you immediately invest in the whole index. So that's a really great thing for small investors. Then cost to buy is of course less than other financial products. That's not completely true, but most of the time you can buy ETFs and stocks for under 1000 francs for a premium fee of 9 francs or less for with other stockbrokers, but I'm going to that later. And then when you buy for more Swiss francs, so above 2000 Swiss francs, for the stock market it will go up to 15 Swiss francs, and for ETFs it will remain 9 francs. So it's you have to look at your stockbroker for that, and I will come to that later as well, so don't worry about that. And then your the annual fee is lower than for other mutual funds. So normally, as I said in a previous video, that the average fee of an ETF on the Swiss SIX exchange is 0.30% in a year, while mutual funds are mostly above 1% and even up to 3%. So on average, they are 1.6, 1.7%. So that's already a difference of 1.4%, and that's a huge amount that cuts into your snowball effect. So you have to take that into account as well. But of course, trader platforms have costs too. So on top of the cost of buying an ETF, you also have to pay your trader platform a fee, and this can be an annual fee or a quarterly fee, but it all eats at your profit, so always look at your costs. So yeah, always look at your costs, so that's what is standing here. And you have brokers that only ask for a yearly fee, some have a monthly fee and some have a quarterly fee. So it's called the custody tax. So you certainly have to look up the taxes that your trader charges, and then the fee for buying it can it can yeah it can change. So for example, with the Giro you have the core selection of ETFs, and when you invest in the core selection ETFs, in fact it's free. So when you buy the first time in a month, it's free. And then when you buy for at least 1000 francs or higher, again it's again free. And when you keep adding, and it's always an higher amount, it keeps being free or something. It's a strange rule, but you can look it up. It's pretty well explained on the site of the Giro, and you can play with it and always pay a fee of 0 for buying an ETF on the platform of the Giro. Except of course you need to pay the taxes of the stock market, and also the tax of the Steuern that you have to pay for buying an ETF. At Swissquote it's a fixed fee of 9 Swiss francs, and there you have to add then of course also the taxes of the canton where you're living, and the stock exchange costs. So buying monthly for 300 Swiss francs at the Giro core selection, that's okay, because you will have 0 fee and only the taxes that you have to pay. But for Swissquote, 9 francs on 300 Swiss francs, that's already 3%, so that's not something I would advise, so that's not really okay. And then of course, yeah, I was talking about the Giro and Swissquote right now, but of course you have other platforms. So you have Interactive Brokers, you have XTB, you have eToro, and many others. So do your own research about it. So it's not because I took Swiss quote with my wife that you have to take Swiss quote as well, because Swiss quote isn't the cheapest one around. It's not expensive as well, because look at the banks. Most of the banks are really, really, really expensive, so I wouldn't advise going to a bank. So for doing your portfolio build up, but it's up to you to what you choose. So, but for Swiss quote, because I have experience with Swiss quote, I will explain what we do in on the platform of Swiss quote. So we started in the first month of a new quarter, because at the end of the quarter you need to pay a flat fee of 15 Swiss francs plus the taxes. It amounts up to 16.16 Swiss francs under the 60,000 Swiss francs marker, because above it you will need to pay 0.025% every quarter on the amount you have invested on Swiss quote. So it's not a lot, but it's a bit, and those bits add up. So you have to keep that in the back of your mind as well. Then we started with an amount of 2,100, 2,400 Swiss francs. I think it was 2,400 Swiss francs where we started with. So that was another 8 months of saving that we needed to do. And the dividend pays then for the quarterly fee. And that's already a problem. So you are saving 8 months of money just to pay your quarterly fee. In with the ETFs that we buy, that give a quarterly dividend. Yeah, they pay for our fee, but then we still don't have our 1 franc every month from the 300 francs that we invested in it. So that's really annoying. So yeah, those are 8 months that you save without having any benefit from it actually. So that's another thing that every time when you look on videos on YouTube, they don't mention the cost, and they all let it seem that what they earn, that they don't have costs, and it all adds up. So it's not completely correct what they tell on those videos. I'm just pointing out the things that you have to keep in the back of your head when you start investing, and that is that, yeah, you really, it takes time, and then in the beginning you hardly see anything, and then you start losing your motivation, and from the moment that you should start seeing it, you stop with investing. But that's not what you need to do. You just need to hang on to it and keep at it, so that eventually you will see those 1 francs coming more and more and more into your bank account. So from then, when you started with 2,400 Swiss francs, then you have to save the next 3 months so that you have 900 Swiss francs, because then when you buy your ETF on Swiss quote and you pay your fee of 9 francs plus the trading fees and stuff, it's and the stock exchange tax, then you will be slightly higher than 1% on the invested money that you put in. And then when you bought an ETF that gives you a nice dividend of more or less 4% in a year. So we invested it in SDGPX and TDIF, so it's an iShares fund and a Van Eck fund that we invested in. And for the past few years, they had a yearly dividend of 3.5 up to 4.5%. So that's on average it's 4%. So we were happy with that, and on top of it, they also have an increase in the price in the meantime, so that's also a really good thing. And they are reasonably stable as well, considering that they are investing in stocks that give high dividends. So the TDIF fund, it's investing in dividend aristocrats, and those stocks tend to move less to the downside and also to the upside, of course. And that gives that when the stock market goes down 30%, your ETF is going down 10-15%, so more or less half. But on the other hand, when it rises with 30%, you will also only go up with 15%. But yearly you have a guaranteed plus minus guaranteed dividend yield of 3.5 up to 4.5%, which is what me and my wife actually really like. So that's why we chose those two funds. Then when you receive your dividend and you, yeah, so I put if possible in between brackets, because yeah, when you in the beginning, in the first year, you have to pay your fees quarterly, so you don't have that much money left over when your fees being paid. But when you have left and you can invest in one extra ETF, when you invest your 900 francs and the, like for example SDGPX is now 29 francs and 10 cents, I think, this evening. So when you have 30 Swiss francs extra to invest from your dividend, then you can buy one extra stock. Don't buy two, because then you will screw yourself, because you won't be able to pay your fee, so your quarterly fee. And then when you go into the negative, the interest rates on negative account amount is really high, so don't do that. And then keep realizing that it's going to pay off in the long run, and that it's beginning, the cost will take big chunks of your profits, but once you pass the 60,000 Swiss francs marker, it's more or less 0.1% per year that you are going to lose. So that's not that much anymore, and your dividends are going to be higher and higher. But that's already 200 months of saving. So it's going to take less, of course, because you will reinvest your dividends that you have left into ETFs as well. So you will get the interest on interest, with what makes the snowball getting bigger and bigger. But in the beginning, it doesn't seem like much, and it seems like you are saving to make the banks or the brokers richer. But at the end, it will pay off. So just keep doing it. And of course, like always, I always end my videos like this. It's important that you do your own due diligence. This is not financial advice at all. It's just what my personal experience that I want to share with you. And this, what we do in Swissquote, I just explained it. That's what we do for our core satellite investment strategy. So our core are those two ETFs where we invest sporadically our money into, and then we have a few stocks. Maybe later I will discuss the stocks where we invest our money in as well. And most of the time that are all also dividend stocks. But we, so far I think we have two stocks that are really more speculative, that momentarily they are struggling, but I think they will perform really well in the future. So we put some money into those stocks as well. And you can do that more buying more speculative stocks when you have a really good core. And yeah, 75% of our money is actually invested in our core ETFs. So that's a thing that my wife and I agreed upon, and it's really important that you discuss your investment strategy in yeah, when you're a family. You really need to agree upon what you do with your money, because that's really important. When somebody gets mad because you invested in that and that was not what we agreed upon, and then it dropped with 10% and you need to sell it off because the other person isn't really happy about the stock that you bought or the ETF that you bought. That's really a sad thing. So better to discuss it upfront than regret it later on. And that's what you should do as well. So decide what is the best strategy for you and what are the best ETFs to invest in for you. I will make videos on different kinds of ETFs, but yeah, now you know, in the two ETFs where we invest our money in, you can take a look at those ETFs as well and see whether or not you like them. They are more or less the same, those two ETFs, but the one is with 100 funds and the other one stocks, and the other one is with 50. So but more or less the companies are overlapping hugely. But by this, I say thank you for watching and see you the next time on my YouTube channel. And if you like to see more of this, please subscribe and hit the bell icon so that you know when I release a new video. And if you subscribe, thank you for that. Until now, I still have 0 subscribers, maybe because my videos aren't that good. And if my videos aren't that good, just comment down below and say you need to take care of that, or think about that when you make a video. I don't have fancy equipment. I use my headphones, my headset to record, and I do my best. This time I put some music under it. That's yeah, it's free music that you can use, so that I don't have problems with yeah, with how do you call it, royalties, because that would suck, of course, that my video gets blocked because of the music that I put under my video. But I can always record it again, I guess. But thank you for watching, and see you on the next video on my YouTube channel. Bye.